I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting with market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good morning, and good morning to our listeners. Good to be with you.
We've seen rallies on the markets and in the price of oil. Are they connected?
Well, yes. You can often get a seasonal firming of crude oil into late September, early October. Let's just put it down to seasonal. And then you've had this relationship whereby if crude goes up, it not only that does that, but also the U.S. dollar goes down. But I think this rally in crude will soon be over. And but man, everybody's on board. They celebrated a few days ago that the various big producers within OPEC were going to, cut back production and all that sort of stuff, which will not hold. There's a lot of production outside of OPEC that will act on its own best interests, and that's the point. With this, we're into a new low regime for crude oil prices, and I think once past this recent high now, they could go down and test that, $26, $27 level that we got down to in the panic of last January. It seems natural to me. So, and that then would bring down other commodities, which we've had here, a recovery in base metals over the last few weeks as crude oil's been improving, and that one would go too. So here's what we're looking at is that, and as crude rolls over, the U.S. dollar will firm, and the chart on the U.S. dollar is actually basing. It's building a pattern similar to last year and even back in 2014, which led to that huge rally when it soared up to 100 as crude oil was doing its first big crash. That's when it went from 105 down. So, yeah, that's looking like it could occur again, this one. So, and the firming dollar, of course, is the worst nightmare for the Federal Reserve System because their whole objective, and they've been talking about this for years now, is they want to get the rate of inflation up in the U.S. and hold it above 2%, which is, a dreadful number. There should be zero inflation. But at any rate, they've not really been too successful in that department, and this contrasts hugely with back in the 1970s when you really were experiencing soaring CPI inflation. And then at that time, they all said, well, we're doing anything. The, money supply doesn't cause inflation to go up. It's the public's perceptions that drive prices up. And other economists went on about cost push or wage pull. I mean, it was a whole lot of nonsense. And they were hammering the money supply, and commodities were going up and wages were going up. But nowadays, when they push the money supply and push credit, bonds and the stock market goes up, and also high-end real estate. So they just don't get inflation like they used to, and so it's actually to the mission of failure when they're saying they're trying to get inflation up to 2%. So we're living in very fascinating times, Jim.
Yes, and I wonder if the real estate boom in Toronto is related to the sale of the Four Seasons Hotel there, $225 million.
Oh, that's part of the boom, yeah. But If you take a look at like the Hong Kong index of for residential, it peaked a year ago in August and dropped down to about 4 months ago, and then it's been going sideways since. Housing index in China is still up, but you've got high-end stuff in Manhattan and in the Hamptons and Florida and England. They're all sideways to down. The market's becoming saturated. So at some point, both Toronto and Vancouver, their prices, residential, will start heading down. So, and that would be tied to speculators burning themselves out, and then the prospect of a firming U.S. dollar. So it'll be exciting.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Bob Hoye. If anyone was thinking about selling coal to China, think again. China, because of their rampant air pollution, is shutting down several coal and steel plants. And they say their air pollution is causing at least 300,000 premature deaths a year. Of course, they don't talk about their horrific smoking rate. I don't think that helps either.
Yeah. Well, you've seen the pictures of Beijing and that air. Well, you know, there's an old saying that people like to live in big cities because they like to see the air they breathe. But China is and Beijing is pretty bad. But they've got there's other problems there other than industrial or municipal air pollution, because they often get huge dust storms and things like that. But they're building coal-fired electrical plants at a huge rate, as is India. But they've got the emissions, particulate emissions and sulfur emissions down to being controlled. And there's no point in trying to control the CO2 emissions because they have no influence on climate anyways. But it's interesting to watch what's going on there.
Well, apparently China now is building a very large number of atomic reactors for power generation. Eventually they want to have as many as the U.S. Locals don't like the idea of an atomic power plant next door. But, of course, in China, your opinion means nothing.
Oh, yeah, they'll do what the government will do what they want, but at least they'll get power built. They'll be able to supply electricity, and whereas in Western countries you have some remarkably successful lobbies that are trying to prevent any expansion of ordinary generation of electrical power, such as from nuclear or hydro, or from natural gas-fired plants. They want it all done with windmills and solar cells, which everywhere it's being tried is showing that it is quite impractical, because every time you have a wind turbine field, there are times when the wind don't blow, so then you have to have backup power, which is a good one is natural gas fired. So, but the whole point of any kind of power generation, is, whether it's coal, nuclear, or natural gas, is you want to have it running flat out all of the time, and then you get your costs down. But this intermittent stuff with solar cells and wind turbines is just that. It's intermittent, and you've got a problem in the grid, and you have to go and build a natural gas plant anyway. So it shows what happens to markets when they become politicized. And man, this is politics at work very energetic. It's amazing, and you take a look at Ontario, province of, they're just as crazy as the California state is about electrical power. So somewhere the tide will turn against doing things politically, and it'll get back to being practical and let market forces decide on these matters.
Well, just the other day, Ontario put a stop to any new alternative energy sources. They're just too costly, and people are protesting record high bills.
Oh, yeah. Well, I'm pleased to hear about that one, because somewhere common sense has got to get into the equation.
Now, British Columbians will be maybe a little concerned that Petronas is looking to sell its stake in Pacific Northwest LNG.
Yeah, that is interesting, that the whole thing on putting in an LNG plant was delayed so long that the premium for natural gas that Asia was having to pay is diminishing, because other people have come in and are providing liquid natural gas. It's like reminds of the furor over the natural gas pipeline from the far north 30 years ago. It went on so long that then natural gas became readily more available elsewhere, and it was never done, whereas that would have been an economic prospect for, who knows, maybe 15 years or something like that. But this is the problem. There's too much interruption by very passionate people with huge amounts of political power. But I think that this is all burning itself out. I think you're going to see popular uprisings against what the elites have been planning for us.
Well, will British Columbians get upset when they get the final bill for Site C?
Well, that's going to be stretched over a long period of time, and while hydropower does flood valleys, it then becomes a continuous source of relatively cheap energy.
Copper is way up, $2.21. Just the other day, it was down to $2.09. Why the big rally in copper right now?
Oh, I think we've got crude oil on a rally for the last few weeks. That's helping the other industrial commodities. And also with this, as we talked about a while ago, is the U.S. dollar has been a bit weak, but I think it's basing. So what we're looking at here is crude oil to head down into about January. Then also there's a very good and reliable seasonal for copper down into around November. And also we still have further to decline in the precious metal sector. You'll go back to the summer, August, when it got exceptionally overbought. We had the upside exhaustion readings and also the pattern stuff on the sequential sell. And we're looking for, on the gold stocks, something in the order of 20% plus decline by late September, early October. That was just a round ballpark number kind of thing. And some of the indexes, gold share indexes, are down almost, or at the low of a while ago, we're almost down 20%. But this, again, is tied to crude oil, the firming in here. And so I think that gold shares are not showing the degree of oversold that we would like to see for a good tradable bottom. So I think that, and then also the big markets, you've got the credit spreads, which have been narrowing terrifically since January, when the panic about the $26 crude oil price was on, and it's come in hugely, a very remarkable narrowing of credit spreads, which is a big plus for all of the financial markets. Now it is reaching, it hasn't quite reached the RSI that we've been looking for. That's momentum, but it's in a pattern now that we would call a sequential buy, and it had to stay down for this week, which it has, to lock in that signal. So next week we'll be probably looking at a the market signal for a reversal in credit spreads to be widening, and that is just going to set the most financial markets back all the way around the world, because it is all one credit market out there. And then for the last couple of weeks, you've had the yield curve flattening, which has been a bit of a positive, and as of yesterday's posting, it looks like the yield curve could be turning towards steepening, and that with the spreads widening is going to be a big negative for the financial markets.
Deutsche Bank, the other day, there was talk that the government of Germany might have to bail them out. Now today, they apparently have a $5.5 billion settlement with the U.S. Justice Department, and the bank itself announced that its balance sheet has never looked stronger in 20 years.
Yeah, well,
so what's
that's
the real story?
Optimism for you. And pleased to see that I don't know what the U.S. was going on about tapping them for so much money, but perhaps at the moment it's settled, and there's a bit of relief. Of course, we've seen that. Deutsche Bank stock has rallied, and the share index of bank stocks in Europe has rallied as well. But these things are, the whole of the banking system is very precarious in Europe. And as it is in the United States, we got that in August, upside exhaustions in bank stocks, particularly in Wells Fargo, for example, and Bank of America. And Wells Fargo has come down quite a bit. Of course, they've got a scandal, but prior to that, there was enough upside in the stock in order to give us the sell signal. So I think banks are going to go down quite a bit. Well, we called it another widows and orphans short on the bank stocks. So.
Well, with banks in Europe being in trouble, no surprise with negative interest rates. How do they make money?
That's it. The central bankers, which have been agents to help commercial banks, are actually now are poison for the commercial banks, because they've got this mania. Now, interest rates have come down. Within the decline is probably a natural decline that's been exaggerated by the central banks buying bonds like there's no tomorrow. So somewhere there'll be a reversal in the overall bond markets, and perhaps this tentative move here in the curve changing and the spreads about to change could change the whole complexion in the credit markets around the world, and it'll be fascinating to watch.
The Bank of Japan is now buying shares in major companies. By the end of the year, the Bank of Japan will be the majority shareholder in some 55 companies. Is that a good policy? That's
absolute madness. You got to go back to 1998 when Long-Term Capital Management, a hedge fund, headed up by a couple of guys who did important work on theories for pricing options and stuff. So they had the academic community's interest plus the central bankers. Now, the senior central banks directly funded LTCM, and the Bank of Italy got really carried away, and beyond directly funding them, took an equity position. So what the LTCM was doing was wagering that credit spreads in Europe would narrow, and they overlooked that you can get a seasonal change to widening, which happened. It began in that May, and they started losing money, and it was the biggest crash to that date, and I think $4.5 billion disappeared in about 5 or 6 weeks. And also, the panic was huge because the senior central banks had loaned money to this fund, and Italy had taken an equity position. So it was a disaster. And what do you have now? You've got central bankers aggressively buying corporate bonds, as the European Central Bank is, and you got Japan long equities. And they've been buying bonds at unprecedentedly low yields, which means unprecedentedly high prices. And in the case of where they're buying equities, it's at exceptionally high valuations. It's not like they're buying it like a crafty trader at the bottom of a market. No, this is recklessness in trying to prove bad theories about managing economies, and it ain't going to turn out good. It's going to be a disaster.
I can understand China doing things like that because they're newbies to a free enterprise market. But Japan and Europe, what's their excuse?
It's going to blow up, Jim, soon.
So find a deep hole, a hard hat, and a couple of tins of old, canned meat or something. No, just trade overbought to oversold and back again. But in between, there's a probability of all of these theories about central banks managing things being put to a severe test. And the important thing is that on the next contraction, the public will have arrived at a common sense point of view where they're going to look at what the central bankers have been saying, what they've been doing, and that they're risking actually ultimately the taxpayers liable for the whole thing, and they're going to say, stop it, you're out of here. A popular uprising against central bankers, can you imagine? But I think it's going to be fun. Bob, thank you so much for chatting with us.
Yeah, Jim. Hey, always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Questions for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.